Today in the markets, the United States and Canada both saw a decrease in unemployment. Saudi Arabia is lowering their oil prices. And how much can central banks really affect interest rates? The S&P 500 was down again, falling 0.81%, making it a week loss of over 2%. Similar to the day before, tech stocks led the drop, with the sectors falling the most being communication services, information technology, and consumer discretionary. On the upside, financials actually had a surprisingly good day. Considering the Nasdaq is comprised of a lot of the big tech stocks, it's no surprise to see them falling 1.27% today. Canada has seen similar things, with the S&P TSX falling 1.4% on the day, led by the information technology sector. In Europe, the FTSE was down 0.88%. In Asia, the Nikkei was down 1.1%. Oil had a pretty big drop, but I'll get into that a little later. Gold was slightly up. There's actually a big day happening in the Treasury market, surprisingly, where we're actually seeing an increase in rates. The US 10-year was up almost 10 basis points, up to 0.72%. The Canadian yield is also seeing a pretty big jump, the 10-year being at 0.6%. You can kind of see the yield curve starting to steepen, but overall, most rates have actually started to increase. The United States Department of Labor released their August job reports, with unemployment dropping down to 8.4%, which is a huge drop from the 10.1% in July. It's actually much lower than expectations of 9.8%. In total, non-farm payrolls increased 1.371 million, slightly above expectations. Average hourly earnings also increased 0.4% month over month, and is actually up 4.7% year over year. The labor force participation also increased up to 61.7% from 61.4% in July, but that's slightly below expectations. There still is a lot of jobs that have been lost since March, with a total of 11.5 million. Of these jobs, a lot of government jobs actually came in this month, with government adding 344,000 jobs. A large portion of that has to do with the census, which will just be temporary workers just while the census is going on, which totaled 238,000. On the downside, though, there is an increase in permanent job losses. The survey saying that it increased by 534,000 for a total of 3.4 million jobs expected to be permanently gone due to the pandemic. It's interesting to note that stocks are down based off this news, even though unemployment decreased a dramatic amount compared to expectations. It's interesting to see how the market's reacting, although I partly think that's to do with just how high the S&P 500 and the Nasdaq currently are compared to earlier in the year. Canada also released their job numbers for August, adding a total of 245,800 jobs. A large portion of those jobs were full-time employment, running about 205,000. It's a pretty good number, as full-time jobs are what we kind of expect to come back, especially with a lot of those jobs being lost. I still wonder, though, how many hours they're going to work, because generally from what I've seen from past numbers is that overall hours worked have seen decreases. The unemployment rate dropped down to 10.2%, which is down from 10.9%. The all-time high in May was at 13.7%. So we have seen a slight recovery in the jobs market. Not as good as what we saw in the US, dropping down to 8.4%, but still a decent number. Total jobs lost so far is about 1.1 million from COVID. So we've seen some recovery there. It's hard to say, though, how much recovery we'll see over the coming months. It's interesting to look at where a majority of the unemployment is coming from by looking at Canada's biggest cities. This just shows you here just the change in unemployment from the previous months and how different cities are dealing with COVID and how it's affecting them. It's interesting to note, if you look at these top numbers, places like St. John's, Halifax, Moncton, they kind of have pretty low unemployment rates compared to what you'd expect from before pandemic levels, where these places, especially like Halifax, had kind of a higher unemployment than places like Toronto, but it's at 10.1% right now, while Toronto's at 13.9%. It seems if you look at kind of the bigger cities, places like Toronto, Calgary, is at 14.4%, Edmonton 13.6, Vancouver 12.8. You can really see how the pandemic is really hurting the bigger cities as they have to close down, so losing a lot more jobs as you don't have the wherewithal to try and social distance and do things like that. It'll be interesting to see how places recover. We might end up seeing, I know I've seen places that are kind of smaller, people are moving to smaller communities. We'll see how that plays out going forward. It wouldn't be market news right now if we didn't talk a bit about interest rates, especially given the circumstances. I thought this article was extremely interesting and just talks about how central banks affect interest rates. And what they're seeing in England is that even though the Bank of England cut their interest rates almost to zero at 0.1%, mortgage rates haven't actually dropped. And if you look at this graph, you can see that some of them are actually even increasing at that 90% loan to value ratio. The 75% is kind of flat, but still up. You kind of expect more of a drop there, kind of in line to similar spread between the benchmark rates. This is sharp contrast between the United States, where you've seen the rate fall. I wonder if this has to do with the quantitative easing programs that are happening in the United States. As I mentioned earlier this week, the Federal Reserve has purchased $1 trillion worth of mortgages. So that would be pushing the rates down, while the UK doesn't seem to quite be having that lowering of mortgage rates. This has been a discussion for quite a while whether or not central banks actually have the ability to cut rates like they say they do. Well, they can cut their benchmark rates and essentially the rates they loan to the bank. Some argue, especially in the academic world, that it doesn't always necessarily mean that's from the central banks, and that in a lot of cases the central banks are actually reactionary, even though they look like they're changing the rates, that the rates are actually going down. I know a professor at NYU Stern has actually talked about this, how if you look at the statistics of it, that a lot of times the central banks actually have a less effect on the markets and the interest rates than what they expect, and that overall they are more reactionary. While oil hasn't been too much in the news lately, especially compared to when WTI was in the negative territory, Saudi Arabia has actually announced that they're lowering their prices for shipment of oil to Asia and to the West, as they've seen the demand and recovery start to slow down as they aren't able to essentially get the price they're looking for. So they're for light grade, they're reducing the price by $1.40 a barrel to Asia to 50 cents below their national benchmark, which is bigger than what was expected. You also see that play out in the oil prices with WTI down about 4.5% so far. It'll be interesting to see how the oil prices continue to go, and whether or not, if we possibly have another shutdown, what will happen to those oil prices, as the energy industry has already taken a pretty big hit so far. So we'll be able to see exactly how they're going to recover in the coming years, as we've already seen many bankruptcies, mergers, and things like that, as well as a lot of governments really don't want to help out the sector due to political issues surrounding the environment. But they will have to do something, as places that are heavy oil dependent, particularly Canada, derive a lot of their GDP, and the government even achieves a lot of their tax revenue. I believe the previous years, about 15% of revenue coming from going to the government is actually from the oil and gas industry. And when you consider the massive deficits we're having, they won't really be able to fully get rid of it without being able to recover that money. While some might say you could technically try and expand the economy in a different area, it isn't as simple as, say, doing that, especially when you're talking about resources and commodities.